50?
a longer
If everybody participates and does the calculations and stuff, a lot faster. If people don't say anything, and I gotta sit around, and it'll take a lot longer. Try to break out the calculators. Huh? Anybody need more blue books? All right. You tell me what to do.
And we're on one side,
Yep.
not that
How? Yeah, I think I missed that.
one. We're on E.
Yeah, we're doing the real estate investment trust, which is on page what? 4.
But we also, we haven't done that for the school, that comes before.
C?
E.
We're doing E now.
Huh? No, he's saying we're doing F now. Real estate. Hold on.
Did we do C?
Yes.
Yeah.
So then we're gonna do
We're missing
E.
We're not done with C though.
We're not?
No.
How hard are we doing?
On the intrinsic, we just found the intrinsic value.
Oh, we did? Oh, we gotta do the weighted average stuff?
Yeah.
Okay. So that's And what were the intrinsic values?
175
Okay, 175.
200.
210
82.7. What we're going to do is we're going to come up with 3 scenarios. So what we're going to do is we're going to give each of the individual models a weight. Okay? And the weights have to add up to 100. So of the 4 intrinsic valuation models, which 2 are the most important when deriving the intrinsic value?
Multiple approach and DCF.
Yeah, multiple approach and DCF. So we're going to want to weight those more than the other 2. So what you need to do is you need to come up with 3 different scenarios. So why don't you just go ahead, think about it, and then give them to me and I'll throw them up there. So if you were the analyst and you were asked to come up with an intrinsic value, you had to come up with 3 weighting scenarios. What would those weighting scenarios be? And then we'll pick the best one to come up with the final intrinsic value. Go ahead. Does everybody know what we're doing? Okay, these weights, what we're doing is we're calculating a weighted average of the valuations of the four models. We know that the two most accurate methods are multiple and DCF, so we want to weight those more. So now it's up to you to come up with a weighting scenario, or scenarios. What this does is it ingrains in your brain the importance of methodology.
Is like the scenario 1, 2, 3, 3 is the highest weight?
It could be, this could be 10, 10, 30, 40, this could be 5, 5. Whatever, scenarios you want to use. I'm just kind of testing you to think, can you think through the weighting process to give multiple and or DCF the majority of the weight and then allocating the rest to perpetuity and Gordon growth. And of perpetuity and Gordon growth, which one's the most accurate theoretically, even though they're two very simplistic models?
Gordon
Yeah,
growth.
exactly.
It's just a percentage split on those four is what we do.
No, you don't want to do an weighted average because we know that DCF and the multiple are the most important. And we know that perpetuity is too simplistic, and we know Gordon growth's too simplistic. So what I'm trying to do is to get you to think, to come up, be creative, and come up with a weighting scheme based on the rules that I just presented.
Perpetuity could be 5.
What else you got, Julia?
Gordon growth could be 20.
I wouldn't go that high.
Oh, could be 10.
You could do 10.
8.
Let's just do 10. We keep the numbers round. And then the question now is for you is which one do you think is the most accurate? DCF or multiple?
ECF.
You could go both ways. So it's really up to you. It's your preference.
DCF.
Okay, so what would be DCF?
12.
No, it's got to add it to 100.
That's a lot.
Huh?
That's a lot.
What?
Like you only give those two 5 and 10, and there's
Well, this is very simplistic. This is, and then you split between these two because those are the most important.
45.
What is it?
45
For what?
for DCF. Sure.
Okay. And then what are you going to give multiple?
4.
Okay. Here's one scenario. Give me another.
2%, 8%.
I wouldn't go to. Just give it at least.
Two left, 5, okay, so 5%.
I mean, you could do 10 if you wanted to, but I wouldn't go. Probably higher than 10. So what did you say?
And then I'll change that. I'll say 8%.
No, let's just keep it round.
10% and 10% as we talk.
All right. And how do you want to do the DCF and the multiple?
I would, let's do 30 for multiples approach and 50 for DCF.
Okay. And then the last scenario. Give me another. Somebody else. Okay, come on, you guys.
For the last one, could you also start with 10%?
Okay.
Scenario 3.
Sure. Okay, now finish it.
5%.
For what?
For Gordon growth.
We know that the perpetuity is better. Gordon growth's better than perpetuity, so
So maybe
why would you do?
not to go over 10. Okay, 15.
Okay, well, be careful because you got other stuff down there too. You're giving a lot of weight to these two when these two are the most accurate. You gotta give them some weight, but I'm just saying, these are the two most important. Okay, now give me the rest.
45 to 42.
for the project at the end of the semester, you're gonna have to come up with your own scenarios.
What would you personally weight it?
Me?
Yeah.
I kinda like this. I like this one.
And then you like the 40 and 45, or would you
I
change
do.
it?
I do. So if this was the one I would choose, I would put this one in the middle. So that the one that you choose is in the middle, and then the other one's in the two scenarios. Okay. But we'll do a survey later and find out, which one everybody likes. Or maybe we should do it now. Because usually what I'll do is I'll do the calculations, and the students will pick the one that's the highest. Okay? And picking the one that's the highest is irrelevant. Because your job as the analyst, you don't care if it's high or low. That's all you care about is that it's accurate. And that the weighting or the different methodologies based on the rules is the most important. The evaluation is just an after effect. You really don't care. You care more about the methodology and the weighting at the end of the day.
Isn't S3 already over 100%?
Excuse me?
Isn't S3 over 100% already?
Yeah, it's 110.
Yeah.
Okay, then that's not gonna work. Who did the math?
I don't know. I mean,
Okay, obviously. So you gotta fix it.
35 and 40.
Excuse me? Go
Is
ahead.
that right?
It has to be
Go ahead.
down 10.
Multiple approach is 35.
What is it?
35.
Okay. That's it? Okay. All right, so let's calculate the weighted average, or the intrinsic values using three different scenarios. This is the way I do it. Get rid of that. This anymore? The math can be kind of, math can be kind of easy. What I would do is, instead of trying to figure out 5% of this, just multiply it by 10.1, so you get 1750 divided by 2, you're gonna get the 5%. Did you get that? Either you can do 175 times 0.05, or you can do 175 times 0.1, which is 1750 divided by 2 is gonna give you the same thing. So you can do some of this math in your head by using whole numbers and knowing how to multiply by 2. So that's a quick way to do it. So what's 175 times 0.05? Or 1750 divided by 2?
875.
What is it?
875.
Now this one's easy, right? Right?
20.
Yeah, it's 20. And what's 210 times 0.4? Do you guys have your calculators or are you doing?
84.
What is it?
84.
And then what's 182 times 97? 182.97 times 0.45.
82.34.
And then add these up, and this is the intrinsic value under the first scenario. Oh, we didn't do a vote yet. We gotta do a vote before we get going, because everybody will pick the highest one. So can you sum that up for me?
195.09.
195.09?
Yes.
Okay, thank you. All right, so let's just look at the weights, okay, the weighting schemes. Scenario 1, scenario 2, scenario 3. 2, 4, 6, 8, 10, 12, 14, 16, 18, 20, 22, 24, 26. So I have 27 people in here. So how many people like scenario 1? Raise your hand. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18. It's like almost 20. And how many people like scenario 2? You can't vote twice. Okay, so this is the one. We'll do the calculations, but we'll use this one as the intrinsic value. Okay. So what is, this is easy, right?
17.5.
It's easy when it's, you know, point ones. 17.5. This one is what, 20? You already calculated it over here. What's 210 times 210? 210 times 0.3?
63.
And then what is that? 0.5 times, what is it?
91.45.
What is it?
91.40, I guess it would be 49 if you're gonna round up to 485.
And then add these up and give me this.
191.99.
91.99, got it. And then let's do this one. This is easy. And it's 200 times 0.15.
30.
30?
Yep.
And what's 210 times 0.35?
73.5.
What is it?
73.5.
73.0. And then what is 192.97 times 0.4?
73.18.
73.18?
Yes.
Got it. And then if you add these up, what do you get?
194.18.
194.18. Are these things pretty close?
Yes.
That's a good sign. That means that these are close to each other. And just notice that perpetuity is the lowest. Multiple is the highest. These two could be the highest. Usually these will be, this will be the lowest in most cases because it's so simple. And it assumes that the cash flows remain flat forever. Okay, excellent. So that's the one we're going to use. Okay, excellent. All right. And what was the intrinsic value?
195.09.
And what's the current stock price? What is it?
157.
Even, 157?
Yes.
Is it greater than or equal to or less than? What is it?
Intrinsic value is greater than.
Got it. Okay. And since it's greater, what's the premium? Everybody know how to calculate the premium? This is how I would do it. 195.09 divided by 157.00, what do you get? You get like 1 point something. What do you get? This is how I would do the calculation. Can you guys do the calculation?
1.25.
1.25? Okay, and if I go -1, what is it?
25%.
25. And what if I multiply it by 100? Do I need these last two? Do I need these last two steps? Can I just calculate this and it's 1.25, I know it's 25%?
You don't need the last one, you already know it's 25.
Huh?
I said you already know it's 25%.
Yeah, that's what I'm saying, so you don't need these two, you don't need these two steps. So if you understand that it's easy to calculate the percentage change really quickly, you don't need the last two steps. So that's all you gotta do is divide these two. And it's easy, sometimes you can just do the approximations and come up with a percentage very quickly. Are percentages hard to calculate?
No.
No, not when you do it this way. Are they hard when you gotta do it this way? 195 minus 157.00 divided by 157. Is that easy to do it like that? Or is it just easier to do the divided? It's just easier to do the divide. So I'm teaching you how to quickly get to the percentages. Okay? So what was it, 25%?
Yes.
Is that reasonable?
No.
What's the probability that the stock price could go up 25% in the next 12 to 24 months?
Oh my god. Almost none. I don't know.
Really?
Something has to happen,
And
right?
what if it's 125? What's the probability the stock price will go up 125%, 12 to 24 months? Probably zero, right? What about 25%?
Possible.
Possible with the tech stock?
Yeah.
Yeah, they move pretty quick, don't they? Are we looking at, where the stock price is gonna go in 12 to 24 months from now? So is that probabilistic?
Yes.
Yes.
But what about if it was 55%? It's kind of high. I mean, I'd be questioning your numbers if it was 55. I'd even be a little concerned if it was 35. But anything around 20 or 25, that's totally doable. Stock prices move, especially tech stocks can move pretty good. So if we're forecasting that the stock price will go up 25% over the next 12 to 24 months, what would be your recommendation? Hello, proprietary trading unit. Hello, all my rich clients. We just ran the equity analysis on IBM and tech stocks. Our recommendation for you is to buy the stock. Oh, and by the way, since this is IBM and Cisco and Salesforce and some of these other large tech companies that make a significant portion of the stock market indexes and these tech stock indexes, we also recommend you proprietary trading units and you ultra high net worth, individuals and maybe accredited investors and institutional investors. We recommend that you do the following trades on the indexes. And what would be your index trade recommendations? What? You've already done it. I mean, how many members have you done? Yep. Okay, what else?
Futures.
Yep. Clients buy futures. What else? And what else?
Buy on call.
What?
Would you buy on call?
Nope. Well, for the ETF, we also found a tech stock exchange traded fund. We would recommend that you do what for those shares?
Buy on margin.
What would be your first recommendation?
Buy call.
What would be your first trade recommendation? Buy the stock. Margin, what's the next one? What's the next trade? On the tech stock exchange traded fund? What? Okay, and what would be the next one? What's this one? What's this one? I already got the right place. What's this one? There's one missing. Say it. Michael. Okay. And for the stock? What are the trades for the stock?
Buy.
Buy. What else?
Buy on margin.
Margin. You guys should know this stuff by now because you're doing it on your memos and it was on the exam. Got it. This one?
Buy call.
metals. And this one,
West.
how many trades do we have? How many? How many? Yeah, okay, there. Four. How many trades? How many trades?
One.
How many total trades? And then you don't have to worry about the other questions on the bottom. The other questions are really geared towards investments. So, you know, if you were building a portfolio of these tech stocks, what would be the, which ones are you tracking? What's the allocation? What's your expected return? What's your risk? These are all the questions.
No, we don't, yeah.
Huh?
We're not considering.
You don't have to answer it, but if you want to answer it, go ahead. All right, you guys want to take pictures of that so that we can do the next one? What's the next question?
Public RE attitude stock valuation.
We're going to use this again for that one too. Maybe I can do the calculation over here, we can go back and do it here. Swing back around, can we use some of the stuff we've already done? How's that sound?
Why is it 12?
Because we have 4 trades here, 4 trades here, 4 trades here, for a total of 12.
Because yeah, I looked at all the other memos, the ones that you handed out,
Yeah,
and are on Canvas, and they're always 36.
yeah, the memos, this is not the memos.
So what
This
is,
is the exam problem,
so why is this 4 and then on the memos it's a different number?
because you're doing,
You're doing also like different stocks and indexes, right?
yeah, this is more simplistic.
What lets you know that this is 4? Because there are 4 things listed.
Yeah. So here's the index trade. These are the 4 trades on the index. These are the 4 trades on the ETF. These are the 4 trades on the stock. I try to mix it up a little bit. So for the memo, you're doing what, 3 indexes and 4 trades.
I think it's.
So that's 12.
It's
And then
up
you're
to-
doing 3 ETFs and 3 trades, so that's 9. And then you're doing, on the memo, you're doing 5 stocks and 3 trades, so that's 15 for a total of 36. In this case, we're just doing 1 index, 1 ETF, and 1 stock. To kind of throw you off a little bit. But everybody puts 36. A lot of people put 36 on the exam.
I'll
Okay?
remember.
Okay. All right, so let's do the ETF over here. I mean, sorry, the REIT. Okay. So you guys are gonna have to help me. What's the first model? Okay, got it. And then what are we valuing? Yeah. What kind of, is it a company? Is it a piece of real estate? Is it a security? What are we valuing?
Stock.
What is it?
Stock.
It's a stock, but what kind of stock?
Tech.
What is it?
Tech.
It's a real estate investment trust, it's a REIT. REITs are special securities. Basically, they are publicly traded real estate companies. But they're not C corporations like companies are. They are a special class of security. Because the Congress was really nice in 1960, before I was born, was really nice to basically pass the 1960 Real Estate Investment Trust Act. Because Congress felt sorry for investors like yourself. They couldn't participate and invest in real estate because it was too expensive. Right? Real estate's expensive. So what Congress basically said is you, the company, what you can do is raise money in the bond of the stock market, take that money, invest in individual properties, build a portfolio, And if the majority of the income that's generated from the company comes from renting the properties, then the earnings that are paid to the shareholders, the dividends, are tax-free at the corporate level. So the corporation, the REIT, does not have to pay corporate level income taxes. So what does that do to the dividend yield? If the company doesn't have to pay capital gain, income taxes at the corporate level, and they can pay, what are they gonna do? Pay more or less dividends to their shareholders? More dividends. And if they pay more dividends to the shareholders, is the dividend yield higher or lower? Higher. So would you buy REITs if the dividend yield or the income return was higher than other securities?
Yes.
Absolutely. So would that attract capital into the real estate market?
Yes.
Absolutely. That was the objective of the legislature. Okay? Okay. And then what's the cash flow metric that we're using? What did we use as the cash flow metric in the last question? Well, that was the methodology, but what was the cash flow metric? What did we use to do the
Earnings
valuation?
per share.
We did earnings per share. And what are we using for the real estate investment trust?
FFO per share.
FFO, funds from operations per share.
Is there a reason why we skipped the last part for part C?
The very, very last part?
It
we
says,
didn't have to do
yeah,
that.
what other stocks?
Yeah, we didn't have to do that unless you want to do it.
All right, fire.
So funds from operations, FFO, is considered free cash flow. It's like earnings for C Corps. FFO is free cash flow for REITs. Okay? And obviously, we're going to divide that by the number of shares outstanding, and that's going to give us the FFO per share. And then do we want to use last year, this year, or next year's FFO per share?
Next year.
Next year. And we're going to divide that by what?
You can divide that by the discount rate.
Correct. Which is going to be, what would it be using?
Going in was 8%.
Yeah, so we're using the expected return. Okay. Got it. And then do they give us the FFO per share for next year? I think they give it to us. Don't they give,
No, you gotta grow it out.
no, don't they give it to us?
They give you the first one at 0, but you have to grow it out for the first year if you want the first one.
Oh, got it, okay. So what's the first year?
$15.
15? And then what's the first year pro forma growth rate?
It's 8%.
Like that? Is
Yes,
that correct?
that would be correct.
Okay, got it. And what's 15 times 1.08?
16.2.
16.2? Is
Yeah.
that correct? And what was the expected return?
8%.
Got it. And what's 16.02 divided by 0.08?
Oh, you mean 16.2?
Yeah, 16.2, that's 15 times 1.08 gives us 16.2. 16.2 divided by the expected return of 8%, which is 0.08, gives us what?
202.5.
Yeah, I got that number 2 on the outside as well.
202. Okay, is that correct?
That's what I got.
Okay, got it. And then what about the Gordon Road? Now, Gordon growth is easy, right? Because we already know what the next year's FFO per share is. We also know what the expected return is. So what was the forecast going in growth rate? 2%? 0.02, which gives us 0.06. And what's 1620 divided by 0.06?
270.
Got it. Okay, and then we want to do the multiple approach. Got it. The multiple approach is pretty easy too, because we already got next year's FFO per share. Do they give us any multiples? Or do we have to calculate them? Did they give us any multiples?
Yes.
25 times 22 times, and what is it, 15 times?
Yes.
Got it. So what's 1620 times 25?
405.
And what's 1620 times 22?
356.4.
And what's 1620 times 15?
243.
All right, so here's the deal, okay? When I started teaching in this class and teaching the real estate classes at San Francisco State in 2014 and 15, 14, 15, 16, 14, 15, 16, in that 3-year time period, were we in the recovery phase of the business cycle? When was the recession? Yeah, 08, 09, 10, right? And then 11, 12, 13, 14, 15. So we were what, like,
Early maturity.
yeah, we were like in the sweet spot, you know, the job growth and production. And there wasn't really a lot of new real estate supply, new construction had not come online yet. So markets were seeing rent spikes and value spikes, particularly here, right? In the apartment market, in the office market. So the REIT shares were being bid up really high because the analysts and the investors thought that the growth rates in FFO were going to be really high going forward. So they slapped a 25 times FFO multiple onto their cash flows. Okay. And then in 2016, 17, 18, and we're in 19, new supply started to come on and the market started to mature. So the multiples started to fall. Okay. And where are we now in the cycle?
Recession.
We're probably maybe a year or two away from a recession. Is there new supply?
No.
Yeah, there's new supply coming on. Yeah, there's new Salesforce Tower, all those office buildings, some apartment buildings, condos have been started to be built. So you have late cycle, new construction, inflection point, maturity in the business cycle. So then you have to ask yourself, what multiple do we use to apply to the next year's FFO to get a realistic intrinsic value?
We do a really low multiple.
Yeah, they're around 15 right now. Okay, but they're not trading at 25 and they're not trading at 22. So this is it. I mean, you know, years ago we were using this, right? I wouldn't go to 30, but this was the high end. I was still using this. Now I need to be using this because this is more realistic. Okay. Okay, what's the next one? DCF?
DCF.
What do we need to know right off the bat?
First year's cash flow.
What's the first thing I need to know for DCF?
How many years out it's
Yeah,
gonna be?
exactly, the number of years. And what is it?
5 years.
1, 2, 3, 4. I'm missing one. Tragic. Okay. But I think we'll live, right? Year 1, year 2, what are we using year 6 for?
For terminal value.
Yeah, for the TV. Okay, we'll get to that next. What do you want to do, numerator or denominator first?
Let's do the numerator.
Oh, shoot, dude. You missed like half the lecture. You gotta watch me. Okay, do you want to do cash flows first, or do you want to do discount factors?
So the cash flows.
Cash flows, okay, what's the first year?
15.
What is it?
Oh, wait, no, sorry, 16.2.
Okay, how do I get year 2?
You're gonna need to grow it by 6%.
How much?
6%?
Okay, so what's 1620 times 0.06?
How do we done this? Isn't the same as the last one?
Yeah, but we're doing a evaluation of a REIT as opposed to a stock, tech stock. Yeah, plus I like to do stuff over again so that everybody like learns.
Got it, okay.
So if you got it, if you understood the last one, this one should be a lot easier.
17.1.
17 point, what?
117.
117, got it. And then how do you get year 3?
You're gonna grow that by 4%.
How much?
4%?
4%.
Okay, and then what's 1717 times 1.04?
That's 17.85.
And how do I get year 4?
Multiply 2%.
And what's 17.85 times 1.02?
Yes.
18.21.
And how do I get year 5?
Same percent.
Is it by 2% again?
Oh, 1%.
And what's 18.21 times 1.01?
18.39.
And how do I get the 6 year?
Multiply by 1%.
So 1.01. So it's 1839 times 1.01.
18.58.
What is it?
18.58.
Okay. And how do I get the terminal value?
You have to add it to your,
Yeah, but how do I calculate the terminal value?
You're multiplying the growth rate.
How do I get
Please say something.
Kinsey, can you help me calculate the terminal value? The terminal value? I know, that's why you guys need to like pay attention. Go ahead.
Is this one where we add up the,
Yeah, but we don't want to do that yet.
oh, not yet.
Yeah, we got to calculate the terminal values.
Okay.
Can somebody calculate the terminal value for me?
Divided by 0.1 minus.
So the terminal discount rate is 10%,
Yeah, terminal determinants 10%.
okay?
1 minus 0.01.
So 0.9,
Yeah.
so it ends up being
Okay, so what's 1858 divided by 0.9?
Divided by 0.09,
Yeah,
206.4.
206.4, got it. And then what do we do with the terminal value?
add it to your last calculation.
Add it to the last year's cash flow, got it. And then what do we get? It's 1839 plus 206.4.
224.79.
224.79. Okay, so that's by TV, or by, actually, it's the total cash flow that I received in the last year of my holding period. Got it. Okay, and then let's do the discount factors. So what's the discount rate?
0.08.
Yes.
Okay. It's a little crowded over here.
Wait, I have a question really quick. For the 224, you add the year 6, right, to the terminal value or year
Terminal
5?
value plus
Year
the
5.
year 5.
Gotcha.
because you use the year 6 to get the terminal value. And you take the terminal value added to the last year in the holding period cash flow to get the 224.79. Okay? Sorry about this, it's got a little cramped over here. So what's 1620 divided by 1.08?
1.16.
What is it?
1.16.
1.1, is that right?
It's 15.
It's 15.
It doesn't. And what is, what's 1.08 squared?
1.17.
And what is 1717 divided by 1.17?
14.68.
And what's 1.08 cubed?
1.26.
And what's 1785 divided by 1.26?
14.17.
And what's 1.08 to the fourth power?
1.36.
And what's 1821 divided by 1.36?
13.39.
And what is 1.08 to the fifth power?
1.47.
Okay. And then what's $224.79 divided by 1.47?
152.91.
152.91.
Mm-hmm.
Okay, got it. Okay. And if we add these up, what do we get?
If we what?
If we add these up, the discounted cash flows.
I got 210.15.
Me too.
Okay, awesome. How am I doing on time?
Wait, how was your
Got
5
1 minute.
so?
Really? Go ahead. What was the question, Julia?
Well, how was your 5 152?
So we took the 1839 plus the terminal value gave us 224.79, which was the cash flow that we received in last year in the holding period. We took the 224.79 and divided it by 1.47, which was the discount factor for the fifth year, which gave us 152.91.
Can we maybe redo that side?
Yeah, totally, this is confusing.
Yeah.
Yeah, I'll do it again. Well, I was trying to get through so I could just go and then jam it through there. Yeah, I can do it again.
Are we done?
Yeah, I mean, you said we're done. How much time do I have?
You have like 20 seconds.
You have no time.
Perfect.
Thank you.
The next class, I'm not gonna be doing any, you have like stuff to talk to me about in your grades and all that stuff, you gotta do it in my office.